Like, I'm not sure exactly right now because I was reading something else.
Okay, because I have to do two things. There are two queries because I know that Naveed and Rashail, did you do that activity 2, which I gave for impairment of cash generating units?
Yes, sir.
So you had some question on that, right?
Yes, sir.
Yes, sir.
Okay. Marisa, did you do that activity?
No, I didn't. I thought the other class was going to be Sunday, so which is why I was working on the homework today.
Yeah,
and
actually,
which is why I reached out to you.
Let me tell you that I know that initially we agreed on 2 lessons per week, but I know that syllabus is long. So I'm just trying to cover as much as possible now so that, we don't get short of time in the end. It's a long syllabus. It's quite long syllabus. So I think that we will continue with 3 lessons.
I understand, sir, but I was kind of unprepared for today, you know what I mean?
Okay.
Because I was planning for Sunday, so which is why I was kind of working on the homework part of it.
No worries. No worries. If you want to ask something about, because I know that if I have to explain this impairment thing of goodwill, it will take less time. If you want, I can begin from here. Maybe some other people are also having some confusion in there. Rashail, Naveed, are you clear with measurement of NCI and the method of NCI measurement?
Yes, sir, I am.
Okay. Then kindly listen, I tell you. Lessons are important. I try to explain and I try to break it down into small pieces and do my job best. But book is like your main source. You should be reading the book thoroughly. And there are a lot of exercises, a lot of practice activities. This book of SPR by BPP is really a very good resource. What I would like, that of course you are attending lessons and I'm explaining, then you refer to the book, you read the book, and there are some questions which you would not understand. And that is the topic of discussion. I've been saying it from day one that SBR is a discussion-based subject. It is not a lecture-based subject that I give lecture and I finish the job. I understand that all of you should be coming with a lot of questions. So please do not hesitate in asking questions, okay? So I wait for you that you send me something on WhatsApp group. What is that? And then if it is a short concept, I would explain there. If it is a long concept, we keep it to the lesson. So let's now, I'll share the book now, okay? So you can see the book now, right? It says impairment of CGUs. Now, before I just went through the book, this question in a very short way, now let's start doing it in detail. We'll spend some 15 minutes on that. It says that the Satchel group is made up of 2 cash generating units as a result of combination of various 100% acquisitions, which means there is no NCI, plus a head office, which is here, which was not allocated to any cash generating unit as it supports both division. So head office has got its own assets, but head office does not generate cash. It is just for administration and supervision purposes of these 2 units. And that is why head office assets are also very little. And then there is unallocated goodwill also. Unallocated goodwill means that there is some goodwill in the group which is not related to any of the division. And they told us there is a division A which has PPE, non-current assets 780, goodwill 60, and net current assets 180. Total assets, the book value 1020, 1,020,000. Here you got 620 million, 30 million, 110 million, 760 million. And head office and unallocated, and the total worth or value of the group is 1090. The recoverable amounts, including net current assets at the year end, were as follows. Division A, 1,000. And we can see that there clearly is some impairment because you can see that here the division A is 1020, but you can recover only 1 million. So there is some impairment. Division B, book value 760, recoverable is 720. So there is also some impairment of 40 million. And then group as a whole is 1825. Here the group as a whole is 1900. So one thing is clear that impairment on division A is 20 million, 1020 and 1 million. Impairment on division B is 40 million, like the difference between 760 and 720. And the total, now how much impairment, if you notice that, and then the total impairment is 75. So if you see that, it is a very simple process. 40 impairment is here. I'm sorry, 20. The impairment on division A is 20 million. The impairment on division B is 40 million. That is clear. But the total impairment is 75. If you pay attention, total impairment is 75. 1825 minus 1900. So 2040, I will only give 20 million impairment to A, 40 million impairment to B, and then remaining is 15 million because 40 plus 20 is 60. 15 million impairment I have to charge to this part, this head office and unallocated goodwill. These 2 areas, we have to give 15 million impairment. Do you agree with me so far?
Yes, sir.
Okay. So that is clear because total is 75. You can only decrease 20 from here, 40 from here, 15 must be done from here. Okay. So how do you do it with division A and B? If you remember the last lesson, we said that first you always take away the goodwill. So if I talk about my division A, I have got here goodwill of 60 and total impairment is 20. So I can take out 20 million impairment from here and my goodwill remaining will be 40. So there is sufficient goodwill to take care of the impairment. I've got 60 million in goodwill, and if 60 million in goodwill is there, out of that 20 million I can subtract. So from 60 I subtract 20 million and my goodwill will remain 40. So this impairment is done. When I talk about 40 here, so if you see that goodwill is only 30, you can cancel it out, you make it 0, but you still have to do 10 million. Where do you take out this 10 million? This 10 million will be subtracted from there. Here, you subtract 10 from here. So this will become 610. Are we clear?
Yes, sir.
Because from division B, I have to impair by 40 million, but goodwill is only 30. So the remaining 10 million will be charged to the non-current assets, not to your current assets. So this is done, this is done. Now the next question is that what do I do with this 15 million, which is on the group level? So first thing is that you do it on the division level, individual CGU, cash generating unit, and then 15 million to here. Always remember this goodwill is gone. It becomes 0. First you write off the goodwill. So how much is remaining now?
5.
Sorry?
5.
5 million.
5.
Okay. Hello. So 5 million is remaining, right? So out of this 10 million, out of this 15, 10 is gone, 5 is remaining, right? And what do we do with that 5? We take it from here. Can I take it from 90 million?
Yes, sir.
That is the answer. That is the answer. If you are not clear, please ask me. Naveed?
I'm clear, sir.
Shoaib? I can take it to Microsoft Excel file and I will show you there. If you want, let's do it. Okay, let's do it there because I'm not getting the feedback. I don't get those confident voices.
So you're taking it out from you're keeping the division separate and the rest allocated.
I'll just do it like this. Listen, I am not in a hurry. I don't want to leave something how to say, half done. We want to do it complete. No worries. Even if we have to take lessons 6 times a week, I will do 6 times a week. But I make sure that what we do it good. This is here. You've got division A, you've got division B, you've got head office, and you've got here unallocated goodwill. Unallocated goodwill means that there is some goodwill in the group which has not been charged to any particular unit. Here I've got PPE. Here you got, do you people see the Excel file?
Not yet.
No, sir. I was about to say it.
Sorry. So here it is. I just took this question from your I just scratch it from your PDF here. So division A, division B, head office, unallocated goodwill, and you get here total. So, and here you got your net current assets. Okay. So I've got PPE here, 780. This is 60. This is 180. We make a total and we do it like this. And in division B, you've got 720, you've got 30, you've got 110, and you make a total here. This is 760. Head office is 90. There is no goodwill to head office, but there are some other assets which are there. And then unallocated goodwill is 10, and this is like here. And then you make a total of this. So this is your situation. And you make a total. This is 1.9 million, okay? This is what they have given us. This is what is the existing situation. But then what do they tell you? They say you that you've got situation here, division A. So I would write down here, I would call it recoverable amount, okay? If I'm in exam, if I'm doing it in exam, that's how I would do it exactly. I would say recoverable amount here is 1 million. Here recoverable amount is 720. And here the total amount they give you as 1825. So then I would say impairment. So my impairment is book value is 1020, recoverable is 1000. So there is a goodwill which is happening, 40 here, and then the group level total goodwill is 75. So now I would say that, so you can make this explanation. Whatever I'm speaking to you, this you have to write down. How would you address this question? Now you have to make a commentary first. Please listen to me. You have to make a descriptive writing on that. You would say that according to IAS 36, whenever there is a goodwill on cash generating units and between head office, we have to write off the assets from this cash generating units. So first we check the impairment at cash generating units level. And within cash generating units, we will take away the goodwill first. The impairment should be taken away from goodwill. And if any balance is left, that should be charged to non-current assets proportionately. If there is any surplus goodwill is left, impairment is left, like in our case, 15 million, that would be charged between head office and unallocated goodwill. And of course, first we'll impair the goodwill, which is unallocated, and we make it 0. So it is not something that you have to write down some literature article, you have to write down a poem, or you have to write down a novel, nothing. What you do, what you think in your mind about this question, what you are doing, you just have to explain that thing, that how do you perceive this question, what do you do? So after impairment, what will happen? You will say that after impairment, this picture would look like this. This goodwill, so I have to subtract like 20 million from here. So I subtract 20 million from here, this becomes 40. So now you've got here this value, and you come here, the book value and the impairment value, impaired amount becomes, the recoverable amount becomes same. Here you have to subtract 40 million. This 40 million, how do you do it? You make it 0. This goodwill all is gone. But still it is not equal, because this is 720 and this is 730. You still have to impair 10 million further. That 10 million from division B, because division B has goodwill of, division B has impairment of 40 million, but goodwill was just 30 million. So goodwill was not enough to absorb all of the impairment. So this 30 million you make 0, and the remaining 10 million you subtract from the non-current assets. You do not touch the current assets, okay? You subtract it from non-current assets. Now this becomes 720, this becomes 720. So a little bit is solved. Now if you pay attention, what do you have here? It says that your recoverable amount should be 1825. You have here 1840. So it means that 15 million further should be written off. And now you've got two options. You have to write off 15 million from this area, which is head office and unallocated goodwill. So very honestly speaking, take away this goodwill. This goodwill becomes 0. This 10 million becomes 0. So now you've got a difference of only 5 million. And this 5 million will be, now there is nothing left here. You cannot further impair it. You cannot further impair it. This is already 0. I mean, this has already come to the recoverable amount. You cannot charge them 5 million more. That 5 million will only be charged to head office. And if we have to charge it to head office, we will charge it to the non-current assets of head office, not to the net assets. So this 90 will become 85. And this is how you will charge all of the impairment. Now, you know the process. You just have to put it in writing. If they ask you, how would you treat it under IAS 36? Because the question it says, discuss. They not only ask you to provide numbers, they say discuss with suitable computations. So you also do computation. Showing the allocation of any impairment losses, the accounting treatment of impairment test. Use the pro forma below to help you with your answer. So you also discussed, you said that according to IAS 36, when there are cash generating units and there is head office, we do it in 2 levels. First, we check the goodwill, whatever is the total goodwill. At the group level, the total goodwill is 75. At the group level, the total goodwill is 75. So we see how much of the 75, it belongs to the cash generating units. So we charge them to the cash generating units. Okay. Not here. So this 75, we charge to the non-cash. And 60 is gone. Whatever is remaining, some part goes to unallocated, some part goes to the head office. Are we clear on that?
Yes, sir.
Yes, sir, definitely.
Rashail? So this question was asked to me by Rashail because he said that, please explain that in class. So I just explained. Listen, there is definitely, I would say that, listen, I'm not saying that I don't want to do my job. I will do my job. I'm doing my job. But at the same time, I must tell you that from your side, a very constructive effort is needed. SBR book would require you to go through, and it's an excellent book. Usually I do not like many books, I tell you. I don't like many books, but this book I really like. They made a very wonderful book for SBR. Okay, anyways, we are done here. So let me see, we are going to the next topic. Okay, so we speak again about, I'll create a situation. The numbers will be better. Alpha acquired Beta company on 01/01/2009 when Beta's retained earnings were 3.5 million and 3.5 million. Beta's share capital is 10 million shares of $1 each. Alpha paid. Okay, Alpha acquired, let me write down here, 80% of Beta. Okay. So it is 10, 3.5. Okay, let me make it 5 million. 5 million. So Alpha paid 15 million to acquire 80% of Beta. It is the group policy to measure NCI at the origin of net assets of Beta. Now I just created a small example. Now can you tell me how much goodwill was there? How much goodwill was paid? Yeah, how much goodwill was paid? So you would say that consideration transferred Beta, sorry, Alpha. How much Alpha paid? How much Alpha paid? How much was consideration from Alpha?
14 million.
14 million. And how much is NCI in this case? How much is NCI now? NCI is 20%, right?
20%.
20% of what? 20% of Beta's net assets, because it says proportionate. So 20% of 15 million, because Beta's net assets are 15 million. 5 million in the retained earning, this is your net asset, and 10 million in share capital. So 10 million of shares. So the total net assets of Beta company are 15 million, share capital and retained earning, which makes it 15 million. So 20% of this one. So it means that the total amount which has been paid is this much. 17 million is being paid. And within 17 million, NCI share is only 3 million. So, and then you say that net assets at acquisition are 15 million, right?
15 million. Yes, sir.
And therefore, you say that the goodwill arising at acquisition is 2 million. Are we clear until here?
Yeah.
Yes, sir.
Now, my question is that this goodwill belongs to whom?
The company, the group, the parent.
Goodwill here, it belongs to the parent.
Yes, sir. Only parent.
It belongs to the parent because NCI, it purchased 20% of 15 million, which is 3,000, and he is only paying 3,000. So NCI is not paying even $1 extra. This 2 million, which has been paid extra, it has been paid by the parent. Okay, now that is IFRS style of working. What if we do not know IFRS? What if two layman people are doing this, are making this deal? Let's suppose. How do we justify the numbers? Like I told you in last class that you have to have the mathematics of that, okay? The basic mathematics of that. What is the value? What is the value of Beta at acquisition? Can you tell me? The value of Beta at acquisition is how much? 15 million, right?
Yes.
And what belongs to NCI? What belongs to NCI? 3 million, which is like 20%.
20%. Yeah.
So it means that what is remaining? So this is what belongs to parent. This is what belongs to parent, 3 million. So the parent got only 12 million of Beta. The parent got 12 million of Beta. And how much he paid? How much he paid?
14 million.
14. So did he pay extra?
Yes, sir.
Yeah.
2 million.
2 million. So all of the goodwill has been paid by the parent. So now I just made it mathematically. So this was your IFRS style of seeing it. And I say, let's suppose I don't know IFRS. I'm a simple businessman. How do I calculate? The deal is between Naveed and Shoaib. The deal is between Shoaib and Rashaya. You say that, you know, this 15 million is the total value. 3 million goes to NCI. Remaining is the 12 million which I get. What the parent is getting is only 12 million. And to get this 12 million, he is paying 14. So he is giving extra. He's giving 2 million. So all of the goodwill belongs to the parent. Clear?
Yeah.
Okay. Now what we need to do. Now there is a concept of gross up goodwill. I'll do that here. Grossed up goodwill. Can you tell me, did you ever heard this thing, grossed up goodwill?
No, sir.
You didn't. Now please listen to me with care because this definitely is a little bit tricky thing. You have to understand whenever I have to explain something difficult, I stand up. You know, because all my life, like for 15 years, I've been teaching like this on the board. So it's very difficult for me to speak and try to make you people understand. I feel that when I'm standing, maybe I can explain better. Listen, we said like this. Let me make a figure. Let me make a figure. With figure, probably you would better understand. This is the company. Okay. This is one big company. Within this company, this much belongs to the parent, 80%. Do you understand my point? So here,
Yes,
I've got here, so this is my parent, which is called Alpha. And this is somehow NCI. This is the small part is NCI. The 10%, 20%, 80% belongs to Alpha. And I would call it 80%. How much goodwill is Alpha paying? 2 million, right? He pays 2 million goodwill. Is it? Yes or no?
Yes, sir.
This 2 million goodwill, he paid on what percentage of the company? He is buying 80% of the company and he's paying 2 million goodwill on that, right?
Yes, sir.
But the goodwill is for the entire company. It is not possible that my part, my 80% of the company is doing very good, so there is goodwill. Your 20% of the company is not doing good, so there is no goodwill. I mean, if you imagine goodwill is actually over the entire business. Goodwill is not only for one part of the business. Do you understand?
Yeah.
Yes, sir.
So we come here a concept of which you called grossed up goodwill. Sometimes it is also called notional goodwill. Notional goodwill or grossed up goodwill. It says that let's suppose if NCI also had to give goodwill. Let's suppose if NCI also had to give goodwill, what it would have been, what it would have been, or what it could have been. Now this goodwill, $2,000, it only represents 80% of the, it only represents 80% of the business. It is only 80% of the business. So for 100% of the business, the goodwill would have been more or less.
More.
Would have been more. And how could you calculate that? You can calculate that with this formula. First I write down the formula, and then you can, I will explain it. 2000 multiplied by 100 divided by 80. This is the thing.
2,500.
So this is the gross stock goodwill. First, do you understand this formula? If you don't, I can explain why.
Explain it, please, sir.
Huh?
Explain the formula.
Okay, so this 2000 is actually equal to 0.80 of X. So if total goodwill had been X, if total goodwill we do not know, right? We don't know the total goodwill, but we say that 2000 is 80%. So let's suppose that total goodwill is X. Then 80% of X is 2000. Okay? Make sense?
Yeah.
And then you can say that X is equal to 2000 divided by 0.8. Please calculate it. 2000 divided by 0.8. You get the same number. When you will see in your book, accounting book, this is the way which is taught to accountants. This which I'm doing, this is mathematics. For me, mathematics is very important. If anything does not come up to make numbers in my mind, mathematics, it is fail. So when you will see your book, they will make you like this. But if you ask me, I think like that. I don't know the total goodwill. So the total goodwill is X. I only know that 80% of X is 2000. 80% of the total goodwill is 2000. Am I clear now?
Yeah.
Okay. Now the next question is, where do we use this grossed up goodwill? Where do we use this notional goodwill? We do not show it anywhere. It is not written on your group balance sheet or group statement of financial position. It is just a hypothetical number to calculate the impairment. We will only use this number to calculate our share of impairment. Am I clear? We are not going to put it on balance sheet. We just calculated this hypothetical number, and we will use it in some form of impairment calculation. Where we do it, I'll go back to the question now. Now I come back to your book. Listen, if anybody has any question until now, please ask me. So you understand that when you calculate NCI at proportionate of net assets, you know how to calculate. Take the net assets, multiply with percentage, that is that. He is not getting any goodwill. Goodwill belongs to the 80%. And then when it belongs to 80%, you have to make it 100% to find out your notionally adjusted. This is the word they are using. For the purpose of calculating an impairment loss, like I said that, if you have an impairment in such a situation, okay, if you are measuring NCI on fair value basis, then you don't do this method. Then grossed up goodwill is not needed. When you say that NCI is measured at fair value, so it means that NCI also has goodwill, parent also has goodwill. So goodwill is already covering the entire business 100%. So then this grossed up goodwill is not needed. Grossed up goodwill will only be needed when NCI is measured at net asset method. See this question here. Illustration number 3, impairment loss. Wait, I mean, let me see if this is a question or this is the question. We do this one. Okay, some years ago, A-Stone acquired 85% of Makulik company for 800,000. So this is parent, 85% for 800. When the fair value of Makulik identifiable net asset was 700,000, goodwill of 205,000 was recognized. It's the same way, like 800,000 minus 700,000 into 85%, just the way I was doing it. Because they purchased this company 700, they got 85% of that. 85% of that they got it, but they paid 800. So they are paying more. So this was the goodwill. And this goodwill, actually, it belongs to the parent. As Makulik's policy is to distribute all profits by way of dividend, the fair value of its rentable assets remained 7,000 on this one. The impairment review indicated that Makulik recoverable amount was to be 660. Okay, this is not something I'm paying attention to, this sentence. I'm more interested here that net assets remained at 700,000 on 31st December. The impairment review says that it is 660. So do you see any impairment here? Balance sheet assets are 700,000, right?
Yes, sir.
And recoverable amount is only 660.
Yes, sir.
So let's see. They say that determine the following. The carrying amount of, oh my God, Dushanbe's asset. Where is Dushanbe? There is no company like Dushanbe. Maybe some typo error. It could be some other because there is no Dushanbe. Carrying amount of goodwill in respect to Dushanbe's after the recognition of impairment loss. Okay, this is we need to do. I'll see the solution. So their solution is not correct because they are giving percentages also wrong. So clearly they just, actually it's not that their solution is not wrong. They just put some other solution here. So question is different, answer is different. And what I need to calculate here, I'll take this one only because I need to show you the impairment and how it will happen. Okay. So what is happening? First, we find out the goodwill. Parent is paying how much? 800,000.
800.
NCI is paying how much? 15%. 15% of what? 700,000, right?
Yes, sir.
Because the net assets of this company were 700,000. They told us in the question that net assets are 700,000. So it took 85% and it paid 800K. And here it is.
So we can't see the Excel.
Oh, I'm sorry. So this is, I was doing an Excel. I said that parent, it purchased, so this is like my consideration, I call it. Okay.
Right.
So parent purchased 85%, parent paid 800K. NCI is 15% on proportionate method, 700K. So it means that the total paid was 905,000. Out of this, now we say that net assets of subsidiary at acquisition date, which were 700K. And here you say goodwill comes out to be how much? This much. Are we clear until here?
Yes, sir.
But this goodwill is just,
85.
and then what you should do? Gross up. How do you do gross up? I've told you, very simple, 205 multiplied by 100. Multiplied by 100 divided by 85. So I got it here. So total goodwill is this much. 241, whatever. Yeah. Right? So we get this number also. Now, why do we need it? We need it because then it says impairment review. Here is the impairment review. Now, impairment review, it says that book value of assets. How much is the book value of assets? 700,000, right?
Yeah,
Yes, sir.
Is it given?
Yeah.
The 700,000 is given where? This 700,000 is in the books of subsidiary, right?
Yes, sir.
But when I purchased this company, I paid something more. So in my books, consolidated financial statement, I also have goodwill on subsidiary, right? So for me, the value of this company would be book value 700K was there. Recoverable amount is how much?
660.
660. So what is happening that for me, it is 700 there on the books, plus my goodwill is this much. This should be the total value of the company. If you talk about the total value of the company, this is how much it should be. 700 the value of, because on subsidiary owned balance sheet, they don't write down the goodwill. Okay. They only write down their net assets, no goodwill. Goodwill is only present in the parent in the consolidated financial statement.
All right.
So on their own books, it was 700 plus in my books, it is goodwill total. So the total value of this company should have been 941.
Okay.
Should have been this much. But how much it is? Recoverable is
660.
660. So how much is impairment? Impairment is 281. Are you clear?
Yes, sir.
So this impairment of 281, this is the total impairment on 100% of company because we added this goodwill, which is 100%. And because this company is also 100%, we are taking 100% of everything.
Right.
Now, do you think that this is the impairment of goodwill? Do you think that impairment of goodwill, all of that belongs to me? No. To parent.
Also, and NCA.
To NCI will not be charged. To parent, how much is charged? To parent, only 85%. So then you say that this multiplied by 85%, 239,000, like 281, 176 into 85%. This is one time you make it up, one time you make it down. You say 239% is the goodwill which should be charged by the parent. Listen, I'll start again. Consideration we paid 800, NCI was 105, total value paid 905, company value 700, goodwill was paid 205,000. But this goodwill, all of that belongs to the parent. It belongs to the parent. And therefore, we calculate the grossed up goodwill, which is 100%. So now this was 85% and 241 is the 100% of goodwill. After that comes impairment review. In impairment review, they told us that the subsidiary has net assets 700K in its books. 700K was in its book, but in parent's book, there was also some goodwill because when we acquired the subsidiary, there was some goodwill. And that goodwill was 241,000, the full 100%. And should have been, so it means that the total value of this business should be 941,000. Out of 941,000, recoverable amount is 660. So this is the goodwill which is happening 281. but this is on full 100% because we took 100%. Now we go back to 85% and we say this is the parent share of goodwill.
Yes, sir.
No?
Clear, sir.
Okay. Let me do it in one other way. Let me see some other calculations. I'm just seeing something different. 105,000. Yeah, this is NCI 105,000. Okay, got it. So any questions until here? Start now. Okay, we start now. So we just did this one. We did the question. We just forgot about their answer and we did our own. By the way, they did it here. Do you see it?
Yeah.
Rashal, do you see this number? Naveed? This is the same number which we did it.
Yep.
281,176.
Yes.
Yeah, anyways, I didn't pay attention that they have this part C because they just confused me here with 80%, you know. I just didn't pay attention. There was something, but this part was correct because we did it like this. We said recognize goodwill, the gross up, and notional goodwill is 36. Actually, they are showing it separately. We added it together.
They have the right name as well.
And we made it 941 and recoverable is this, and this was our answer. If we go back 281,176, we go back and we check the answer if we did it correct or not. I think we did. Yeah, this is 281,176. Because I just took a total of 241. They were showing it gross up amount as a separate number 35, which is not needed. You can just do it like this, 241, 100%.
Okay.
And they got the same answer. This 281, this is the same answer in the book also. So at least we verified the answer. You know, from this book, I'm teaching SPR for the first time because this is just the latest version of that. So therefore, there are some questions which I'm not sure, I've not seen them before. So this is one of them, and that's why I thought that they didn't do it. So we spent some time ourselves. Anyways, there's another concept you call reversal of past impairments. It is possible that you charge some impairment. So you said that, you know, in what is happening, that you have your assets here, and you say that asset got impaired, the value goes down. But after some period, it goes up. So when it goes up, this much of thing is called reversal of impairment, because this is like, let's suppose you already charged 20K and now it has gone up 40K. So 20K, you will consider reversal of impairment. Remaining 20K, you should consider as increase in the value, the revaluation. So this part is called impairment reversal, and this is revaluation. It's quite simple. Does that make sense or not?
Yes, sir.
It is very simple. You call it reversal of impairment. Okay, so you can read the minor details yourself. It says that a reversal for a cash generating unit is allocated to the assets of the CGU except for goodwill, because you should remember always. Goodwill, like if it is impaired one time, it is never reversed back. Okay, if goodwill value comes down, you cannot increase it up. So any increase in value will go somewhere else, but goodwill does not have any reversal. Like your building can go up. You say my building was 1 million, it goes down to 900K. Now it is going up to 1.1, so you increase it. But goodwill, once you decrease it, you don't increase it. Okay, so except for goodwill. However, the carrying amount of an asset is not increased above the lower of its recoverable amount and its depreciate carrying amount. Like you cannot take it higher than that. Then comes fair value measurement, IFRS 13. I will teach it separately. I'm skipping this standard. It's not time for doing IFRS 13. I know when we have to do it. I move forward and we talk about intangible assets, IAS 38. A very simple standard. I would suggest you people to watch F7 video for intangible assets. You've got the access there. Intangible assets, you know, you are developing writing down a computer software, you are making an application, you are making, you know, some new tool, some intangible asset you are developing. You're working on some technology. And what will happen that you would spend hundreds of millions of dollars on research and development cost. You call them research and development cost. So as far as IAS 38 intangible assets are concerned, we are primarily concerned about that we spent, I don't know, $100 million on research and development. Now, what do we do with this money? So a very simple thing was, and it's not very complex here as well, that research, so you split that, this 100 million, where do you spend? You say that 30 million I spent on research phase and 70 million I spent on development. Now, what is the difference between research and development? Like it's F3, F7 level, but I have to repeat again. Research is the first stage in which you are acquiring the knowledge, in which you are getting the knowledge. You have not yet started the work. You are just doing the planning phase. That is called research. Development is the second stage. So once you know what you have to do, your planning is done, you have acquired the knowledge, you have purchased the technologies or whatever, or purchased the knowledge as well. And then you say, let's start development. The moment you say, let's start making it, your development stage begins. So let's suppose in a software development, when you have to write down a software, first 3 months, you just spend on collecting the requirements. You meet many different people, you ask them what type of features they need, you test different technologies, you discuss different consultants, and you are planning, I will be using which database, which one would be the front end, which one would be the back end, and stuff like that. And you had a team of 10 people. You were paying salaries, you were paying rent. So first 3 months were only spent in planning phase, and you paid $30,000 in first 3 months. This money, which is spent in the stage 1, it goes to the income statement without any question asked. Straight into income statement as your OPEX, no question asked. This 70 million, which you spent on the development phase, it can go. Okay, I'm using the word it may go. This must go. This 30 million, I would say must. Okay, there is no other option. But this 70 million, you can take it to the balance sheet. I'm saying you can take it to the balance sheet and capitalize and call it as your asset. But this is may. It is not must, which means that the 70 million can go here if the 6 conditions are met. IAS 38 gives 6 capitalization criteria. If even one of the capitalization criteria is not met, this 70 million will also come to the income statement as OPEX. IFRS is very conservative on capitalization of assets. You only capitalize assets when you are very much sure. If there is any uncertainty, take it to the income statement. I'm repeating it again. Total expenditure which you spend on R&D would be split between research and development, where research being the stage 1, whatever you spent in stage 1, all of that will go to the income statement as your operating expense straight away, no questions asked. The 70 million, which you spent on the development stage, you have an option to capitalize it into your balance sheet as your non-current asset, intangible non-current asset. You can take it, but only if it meets the 6 capitalization criteria. If any of the criteria is not met, that will also go to income statement and treated as expense. Am I clear?
Yes, sir.
Yes, sir.
And what is that? That criteria is called, pirate. Pirate. You remember the word pirate in your mind. Pirate, like you will read the book also. Pirate means P stand for that there is a probable future economic benefit. Of course, if there is no probable benefit, it is no asset, no capitalization. So the first criteria is that there is, okay, let me erase it and write it better. I would call it P-I-R-A-T-E, pirate standards, pirate criteria, where P is there should be probable economic benefit, because no benefit, no asset, no capitalization. Then intention to complete, sell, and use. You should have an intention to complete it or use it or sell it, because if there is no intention of completing or using it, there will be no benefit. You don't complete it, you cannot get benefit. No benefit, no asset, no capitalization. Resources available to complete. You should have physical and financial resources. Like you start a project needs 1 million, you have got only 300,000 and you start the project. What would happen? You will stop in the middle. Your money will finish and you cannot continue. You cannot continue, it is left in the middle. No benefit, no asset. Take it to the income statement. It could be technical resources. You don't have technical people to complete it. If it is incomplete, no benefit. Take it to the income statement as expense, because you can't keep it on the balance sheet because you don't expect any benefit out of that. Ability, A stands for ability to use or sell the asset. Because if you cannot use it, if you cannot sell it, you cannot get benefit. No benefit, no asset, no capitalization. And then technical feasibility. The project should be technically feasible, which means that it should be saleable. It should have some commercial value. Probably you are not working on some outdated technology. So technically feasible. And the last one is that estimate should be there. Its cost should be measurable, because you remember that asset has 2 criteria. Number 1, probable economic benefit. Number 2, reliable estimate for the cost. So when these 6 criteria are met, you take it to the balance sheet as your asset and record it as your intangible non-current asset and start charging depreciation. You know what will happen? They will tell you in question, what type of question will come in SVR. They say that you start some asset here. So this is the research stage, and then you come to the development, and this is the point. They say that in the question, they will call it very clearly that on this date, let's suppose that this is May 2010 or whatever. This is May. They said that on 1st of May, the management believed that the asset would bring the future economic benefit. So you started working here, but you were not sure that it would give benefit or not, because it's not clear what it will become. But on this particular date and question, they will always say it very clearly in these wordings that on 1st of May, or let's suppose on 1st of July, the management believed that the asset will bring future economic benefit. So this is the date from where capitalization will start. So any expenses which you spent before that, this part will go to your income statement as OPEX. Am I clear?
Yeah.
So they will tell you in question the date exactly, that on 1st of June or 1st of May, 1st of July, that was the time when it was established that it will bring future economic benefit. Now, this is the time where you should start capitalization, which means you take it to the balance sheet and you start capitalization. Do you also start doing amortization? You know that depreciation is on tangible asset, amortization is on tangible asset. So I start capitalizing it. I start recording this money in the balance sheet, okay, for this period. So let's suppose I'm spending $1 million per month. So June 1 million, July 1 million, August 1 million, September 1 million, October 1 million. So there will be 7 million in the balance sheet capitalized. And this 5 million will go to the income statement. First 5 months, 1 million, 1 million, 1 million, 5 months, go to the income statement. This 7 million will go to the balance sheet. Should I depreciate it now? Naveed, if I'm taking it to the balance sheet, should I depreciate it here, amortize it here? No,
Yes, sir.
no, we don't. When does the depreciation start?
Because it's in the middle of the year.
When the asset becomes available for use.
Yes, sir.
Oh,
Development is being done.
yeah,
I'm capitalizing it. I'm taking it to the balance sheet, but development is still being going on.
Yes,
Asset has not yet finished. It is not available for use. So don't make this mistake that charge depreciation for 7 months. You will charge depreciation when they say, okay, now the asset becomes available for use. Let's suppose the asset becomes available for use here in this period. So balance sheet, you take 7 months, 7 million, but depreciation you calculate only for 2 months, not for the 7 months.
Yes, sir.
Does that make sense?
Yes, sir.
Good. Okay, so this was rather simple standard. This is the only thing, like what I was speaking here about this Pirate criteria. This Pirate criteria is until F3 and it is also in F7. If you talk specifically about SBR, this concept is SBR. That where do you capitalize and when do you depreciate? And it's not something very difficult or technical. So that's an easy standard. I would suggest a good reading. Just read it good. And that's all for today.
okay, thanks, sir.
Oh,
If you
so
have
that
any-
was it.
Wait a
I
minute.
thought yet.